In this video, I will share a specific entry point that I have never disclosed before. And I also affirm that if you practice it diligently, it will undoubtedly become one of the most powerful weapons in your arsenal. This video could be one of my most dedicated ones ever, and it will explain in great details so that both newcomers and experienced traders can understand. Please prepare pen and paper to take notes, and feel free to watch the video multiple times for a better understanding. I have gone through many years of wasted time, with ineffective methods, confusing indicators, only to eventually discover that simplicity in trading leads to effectiveness. Simplification in trading is the key. To begin, we need to talk about the market structure, which you might have heard of as the three phases of the market: uptrend, downtrend, and sideways. However, for greater clarity, we will divide it into four phases. First is an uptrend structure, second is a downtrend structure, third is a sideways phase with patterns, and finally is a sideways phase without patterns. The upward structure consists of successive waves, breaking previous highs. Similar to the declining structure, there are consecutive bearish waves breaking below previous lows. That is the theory most of us have learned. This theory is not wrong, however, there will be times when the market moves up or down sharply. So for me, you may not need to define this too precisely. There is no theory that is 100% correct in this market. Simplify it with your own intuition. If you observe that it has been declining in the recent period, then it is indeed in a downtrend. Sideways movement indicates a sideways trend. If it goes up, then it's considered an uptrend. Let's simplify everything like that before. Next, I will talk about the sideways phase, both with patterns and without patterns. A sideways structure with a pattern means that prices are moving sideways, but within a defined range that is easily recognizable, such as a rectangle or triangle. This pattern also exhibits a well-defined sideways phase. At this stage, this is the consolidation phase within a rectangular range. Or during this phase, it's sideways within a triangle pattern. Or here. You may find it difficult to recognize due to the significant amplitude. However, let's switch to a daily time frame to get a clearer view. This is precisely the amplitude within the triangle pattern. The structure is moving sideways without clear patterns, meaning the price is continuously touching peaks and troughs and then reversing. There are usually many candle wicks appearing. In this chart, we can easily identify such phases. They could be these phases, or these phases. Although, it still remains within a sideways structure with the rules of a larger time frame. Or this phase. We can see the price breaking the bottom here. But then immediately, it turns back up to touch this peak. So whether you are in a buy or sell position in this case, you are very likely to get caught by a stop loss, especially if you are using a limit order. Thus, our first task, focus on the clear trend and sideways phase with patterns. Avoid the market during patternless sideways phases. During such phases, you can easily observe with the naked eye if you use a chart without indicators. You may not be familiar with it at first, but practice gradually. And even if you encounter difficulties in determining, it's okay, because this is just an overall perspective of the market. Now, we are starting to delve into the detailed steps to identify a clear entry point. Step 1, we will identify potential buying and selling zones during different market phases. In an uptrend, for example, we will have a trend like this. The market is a struggle between buyers and sellers. Buyers push the price up to this level, sellers push it down, then stronger buyers keep pushing the price up, when forming an upward impulse wave breaking to new highs. We'll have to potential buying areas. That is the starting point of a new wave. And another area is the recently broken old resistance zone. Why are there two potential buying zones? For the beginning of a wave, it represents the transition zone from a downtrend to an uptrend. It means shifting from the dominance of sellers to the dominance of buyers. That's how it pushes the price up. Therefore, when the price returns to this zone, the buying side will tend to continue aggressively and buy. The previous peak level is the area where the selling side entered heavily here with the price breaking. Sellers have entered once before. When the price returns, the selling side comes back in force. However, the buying side pushes the price higher. Strong buying pressure here. Only then will the price break through the peak. So this is also a potential buying zone. And these two buying zones will be supported if there are strong bullish candlesticks and uptrend waves in these areas. That is the price momentum, which is the force of the price. However, due to the two factors mentioned above, we have an observation. However, due to the two factors mentioned above, we should take note that if the price doesn't break through much but only breaks through slightly before reversing, so can we still find entry opportunities here? At this moment, we can also observe that the buying pressure is very weak, and immediately the selling pressure pushes the price down again. Therefore, this area is no longer a strong buying zone. So if we attempt to buy at these levels, it will be much riskier. If the price breaks out too far and then retraces to this area, can we still consider buying at this point? We observe that the price breaks out strongly to the upside, but later, due to some reasons, possibly encountering a strong resistance level, the price swiftly retraces back to this level with significant force. This indicates that the selling side is very strong and is regaining the advantage from the previously strong buying side. Therefore, in this case, this area is no longer a good buying zone. That's why we have the application of Fibonacci. When an uptrend wave breaks to new highs and then retraces to the Fibonacci levels of 0.5 or 0.618, coinciding with the previous peak, it forms a good buying zonal because its price isn't rising too weakly here, nor too strongly there, but rather increasing at a balanced rate. It is only in such situations that Fibonacci becomes effective, rather than using it indiscriminately. Fibonacci does not indicate the supply and demand factors, but it will demonstrate the balance between waves. Therefore, when Fibonacci coincides with this area, it becomes a very attractive buying zone for us to watch for entry opportunities. Saying that doesn't mean you must apply it mechanically as above. It will help us distinguish better and worse buying and selling zones and to have a good entry point. It not only requires those factors, but also various other factors. Similarly, as with a downtrend, the opposite applies in the case of an uptrend, where we also apply to identify a good selling zone. For sideways movement, there are patterns like oscillating within a rectangle or triangle. Here, the buying or selling zone corresponds to the two sides of the rectangle, or the edges of the triangle pattern, especially after the price breaks through these two zones, and then retraces to retest these zones. Thus, we have identified what constitutes an effective buying and selling zone in various scenarios. Step 2. Identify signals for entering a trade. In an uptrend, once a potential buying zone has been identified, a favorable trade entry signal is indicative of a depletion in selling pressure, and buyers starting to confirm their dominance. Determining entry signals is also crucial, because if we only watch for resistance areas to place limit orders, it can be quite risky. When reaching the buying zone leads to three scenarios. Firstly, it reaches the buying zone and reverses the trend. Secondly, it broke, meaning it cleared through and then reversed. We often refer to this as a false breakout. Thirdly, it's not reversing but continuing downwards. So in these three scenarios, if entering trades without waiting for signals, there will be two cases hitting stop loss. That's the reason why determining entry signals is crucial. For a buying signal, three phases are needed. The first phase is characterized by gradually weakening selling pressure. For candles, this is manifested through hammer candles. Or for waves in smaller time frames, more green candles will appear. The price momentum will shift from uphill to gradual downward tilt. The second phase is the battle between buyers and sellers. For candles, it could be a few short candles with unclear small bodies in this phase. It's advisable to have more than two candles for clarity. For waves on a smaller time frame, it could potentially represent a sideways price phase. The third phase is the confirmation of the ongoing trend. After the consolidation phase, a long-bodied bullish candle will emerge. It breaks through the previous consolidation period. Now we will go through a few examples of both cases, where we will enter trades and cases where we won't enter trades. As we have just analyzed, this also happens to be an entry point. You can observe that despite this preceding wave not breaking through this particular peak, we can consider it as a buying zone due to two main reasons. Firstly, its upward momentum is very strong at this point, and secondly, its primary trend is also a clear uptrend. We can observe this here. So first, I will enter a trade here. Since we don't see the nearest resistance level, for the time being, let's set a specific take-profit level. For instance, let's consider a risk-reward ratio of 3R. Now we will continue to observe the price developments. Let's take a closer look at this area. In this case, it can also be observed that this area is not a strong buying zone, despite the previous price breakout. This holds true in situations where the price breaks prior resistance weekly. Therefore, in this scenario, the potential buying area lies in this zone. And here we can also clearly observe the entry signal. Firstly, the weakening selling pressure is evident through candles with very long lower wicks. The second is the consolidation period, evident in these three candlesticks. These two candles exhibit long lower and upper wicks. These three candles have very short bodies and are oscillating within this range. The third element is the confirmation of the ongoing trend. It's confirmed in this candle breaking through this area. If no prior entry, this also serves as a subsequent entry point. Now let's continue to observe the price developments together. This area could potentially serve as a buying zone for us. However, we can observe these candlesticks appearing during a phase of weakening selling pressure in phase 1, and phase 2 represents a period of contention between the buying and selling sides through these small candlesticks. However, it lacks a confirming element of ongoing trend continuation through a candlestick displaying the strength of the buying side. Hence, this point is not yet tradable. Earlier, we had a buying zone here, and this entire zone represents both phase 1 and phase 2. This indicates diminishing strength and a phase of contention between the buying and selling factions as evidenced by this zone. Subsequently, these two candlesticks confirm the continuation of the trend by breaking through this zone. Therefore, this also serves as an entry point for us. Subsequently, the price surged significantly, consistently surpassing our target profit levels. We can see here that it's also a potential buying zone. However, in this context, it does not depict the second phase of the struggle between the buying and selling sides. It merely indicates a weakening strength of the selling side, and it signifies the third phase, confirming the strength of the buying side as it intensifies. At this juncture, a trade can also be initiated when this candlestick pattern appears, and the stop loss SL is placed below. In a different scenario, we have a case like this. First, let's take an overall look to determine the nature of this phase. Thus, we can observe that this period is currently a sideways phase and lacks any discernible patterns. We can observe its breakout here, breakout here, break here, and then subsequently decline. So at the very least in this scenario, we will wait for the price to break through these two zones. For it to establish either a clear downtrend or a distinct uptrend. And prior to this segment, we can also observe its preference for a decline, followed by a sideways movement in this section. Now we will continue to observe its price action. Thus, we can observe here that the price has broken through all of these zones and this zone. And in line with the scenario, we could consider shorting at this level. These will be potential sell zones for us, or this area. Furthermore, its downward momentum is quite strong. However, crucially, we'll await signals at these levels. In these instances, it can be observed that the price still reacts, but it lacks the required 3 stages of signal formation. Therefore, in this segment, there will be no entry orders. The same applies to this section. Despite the sharp decrease in candlestick size, it remains within a region where the buying side can maintain control. Therefore, it's not advisable to enter a trade hastily. However, at this stage, after the price has reached this level, the first phase emerges, which is the diminishing strength of the selling side, and the second phase is the period of contention between the buying and selling factions. We can observe a period of consolidation within this range. And the third phase is the confirmation stage. It is confirmed by this candlestick. So here, we could also enter a sell order. And first, set the take profit at this area. The ratio is to R. In this case, we can observe that the buying pressure no longer holds within this area. However, in this scenario, the buying side still holds its ground. Furthermore, if the price intends to continue its upward movement, upon retesting this zone for the second time, this candlestick is likely to break consecutively to new highs. At that point, we will not enter a trade. However, a valid signal has emerged in this area, and we will enter a position here and continue to observe the price developments. when the price has broken through this area and then retraced. However, it didn't establish a resumption of the upward trend, and promptly plummeted due to these two candlesticks, breaking through all these levels. Therefore, in this case, we can trail the stop loss to the entry point and above this peak. Secure stop loss here for position maintenance. As price reaches down, alternatively, consider profit taking as price exceeds 1R. Another important note is that in cases where it has not reached the TP area yet, its momentum decreases. Here, it has attempted to break down twice, but has failed to do so. So I think the segment should be closed. Thus, we can consider taking profits here if the price approaches our target profit zone. The actual take profit zone is within this region. That's the first differently colored candle within the preceding downtrend. Alright, we will continue to let the price run. In this phase, it forms an upward structure. If we miss the take profit, consider doing so now. At this stage, we can observe that the price is still within a sideways range, but it will give precedence to the upward trend. Price breaks this resistance, retests, and pushes higher. Yet, this segment isn't a strong entry signal. It's where we can consider buying. This section also doesn't generate any signal, and our buying zone can potentially shift up to this area. Here, there have been two phases observed, a gradually declining momentum phase and a phase of contention between the buying and selling sides represented by these two candlesticks. Now we will await the third phase, which is the continuation trend confirmation phase. If it doesn't materialize, we should also refrain from entering trades during this period. This is the confirming candle, thus all three phases are complete, and we can enter a trade at this point. At this zone, it also acts as a resistance area. But if we take profit here, the risk-reward ratio won't be favorable. Hence, we should anticipate a breakthrough of this zone and a rise up to this level. However, if it reaches this zone but fails to breach it, we will interpret the candlesticks and exit the position early. So after that, approximately 3 candlesticks, it hit our take profit. So, these are a few examples of scenarios in which we should and should not enter a trade. And at the end of this video, I also want to share a few thoughts with you. Most traders aspire to execute a few trades every day, because the desire for profits leads them to believe that trades must be placed regularly in order to make money. However, the reality is that professional traders only wait for the most favorable entry points. They wait for moments when the market forms a clear structure, then await the creation of a valid signal according to their rules. They seek reasons to stay out of trades rather than reasons to enter trades. When your value becomes significant, you will understand this. With a smaller value, you might be more willing to take risks. But when your value is large, your psychology will be different, and certainly, you will have to be more cautious. And finally, the key point is to backtest for successful trading execution. The second aspect is always managing the capital for each entry. The third is the need for patient adherence to proper rules before entering. If you find the video helpful, please like and subscribe to not miss any upcoming content. Goodbye and see you again.